The traditional market and cryptocurrencies are crashing, triggering extreme fear. Speculation is everywhere, with many claiming that Donald Trump is deliberately pushing the United States into a recession. In a news cycle driven entirely by fear, where the European Union reacts to US tariffs, only for Trump to respond to that reaction by imposing even more tariffs. Investment giants like JP Morgan have raised the probability of a recession to 40%. So are we witnessing a full-scale financial apocalypse? Are all economists right, or are they getting it wrong? It's crucial to understand how the S&P 500, the traditional market, and the crypto market have been moving in strong correlation over the past few years. Right now, you can see Bitcoin's price in yellow, while the candlesticks represent the S&P 500 index, all displayed on a daily time frame. As you can observe, when things go well for equities, crypto benefits as well. But when the traditional market struggles, cryptocurrencies do too. That's why, since November or late December 2022, both markets have experienced a strong period of growth. Ignoring the correlation between traditional markets and crypto in 2025 is completely irrational. And this is precisely why we care about what the average retail investor is thinking. This is the key question we need to ask. Now, if we remove Bitcoin's chart from the equation, let's consider this in the context of a significant drop in traditional markets, where we've already fallen by 10%. What do you think the average retail investor is doing right now? Do you believe on average they are being bold, staying cool-headed and buying, or are they panicking and selling everything? Now, I've just added the volatility index, the VIX, below my chart in yellow. This indicator measures moments of high momentum and extreme volatility, usually driven either by FOMO or, on the contrary, by fear. In other words, when you look at a chart, regardless of the asset, and it's calm and steady, I can guarantee that no one around you is asking about it. On the other hand, when we see that an asset wakes up, regardless of the direction it takes, let's say it moves upward, I'm sure that at that moment, people around you will start messaging you on WhatsApp, calling you, or bringing it up at dinner, saying, "Hey, I've seen this asset, and it looks really interesting." The same thing happens when that asset, after a period of calm, suddenly crashes. That's when it catches the attention of retail investors. It doesn't matter in which direction it moves. When there's volatility, when there's a strong price movement, the urge to make decisions grows among retail investors. This is exactly what the VIX, the volatility index, measures. It tells us when small investors are showing more interest. Now, let's take a look at the recent chart and identify moments where the VIX has captured significant market movement. We can see how these spikes often align with turning points in the S&P 500. It's important to note that the VIX is calculated using S&P 500 options, specifically out-of-the-money options. An option is considered out of the money when its strike price makes no sense to exercise because it would lead to a loss. So, if out-of-the-money options rise in price, the VIX goes up, signaling fear and expectations of greater market movement. On the other hand, if these options drop in price, the VIX decreases, indicating market stability and lower expected volatility. In simple terms, the VIX measures how much traders are willing to pay for out-of-the-money options, because in times of uncertainty, people pay more for protection. That's why, in long-term contexts like the one we're in, it becomes a highly relevant indicator. Here we can see how the VIX spikes during a period of extreme fear in the traditional market, and right at that peak, prices start to reverse. Moving forward a bit, we notice another VIX spike, coinciding with a moment of sharp decline and market panic, once again, followed by a price reversal. And when we see an aggressive spike in the VIX, like in this case, where the drop was truly intense, it once again marks a potential turning point for price action. Ultimately, what we're measuring here is fear itself. You could analyze every peak in the VIX and start drawing several conclusions. But the key takeaway is that in this major market downturn, where you don't even need the VIX to tell you fear is present, when we do check it, we can clearly see the indicator rising rapidly. Fear is evident, and you already know what the big institutions do, what they thrive on to orchestrate their moves. These massive institutions injecting billions of dollars into the market, whether it's Morgan Stanley, JP Morgan, major investment funds, or banking giants, have a fundamental challenge. They need to deploy such a large amount of capital that finding counterparties becomes difficult. And without a doubt, that counterparty is the retail investor. So, in these scenarios of panic and fear, it's well known that retail investors start selling out of fear. We just saw this reflected in the VIX. It's not something I'm making up. And because these major investment funds require significant counterparties, huge amounts of liquidity moving in the opposite direction to their interests, that's exactly why they love and take full advantage of these fear-driven situations. They absorb all that liquidity. And where does this fear come from? Of course, from various macroeconomic metrics. Every year, highly respected economists warn us about an impending recession. This time, they say it will happen in 2025. Last year, it was supposed to be in 2024. The year before, in 2023. And so on, year after year. In times like these, having a good memory is crucial. Now, let's look at how fear is being fueled by headlines like this, raising the question of whether Trump is deliberately pushing the US into a recession. Trade wars with Mexico, Canada, China, the European Union, this never seems to end. We practically get a new new headline every single day. And now the latest narrative is that US President Donald Trump shocked everyone last weekend by not ruling out the possibility of a recession happening this very year. In an interview on Sunday Morning Futures, he was asked about the likelihood of a recession, and instead of dismissing it outright, he simply said it could be a process that takes time. And just hours before Trump's statement, Treasury Secretary Scott Bessent had already acknowledged that it's time to prepare for an economic hit, something he described in an interview with CNBC. At the end of February, the Commerce Department reported that personal spending fell by 0.2% in January, below market expectations. Meanwhile, SP Global has pointed out that the latest PMI data, now being released, indicates a significant slowdown in business growth in the US and rising prices for goods. However, there seems to be one exception: the labor market. With 111,000 non-farm payrolls added, February's employment data suggests there's no sign of a recession, at least for now. But we're left with an open interpretation which, to be honest, doesn't sound too optimistic. Still, it's nothing more than speculation when compared to what Donald Trump and the Treasury Secretary have been saying. Then, a few economic indicators drop by a fraction of a percentage point, and suddenly, just like that, everyone's declaring a full-blown crisis, all within a market that's already down 10%. Now one might ask, what about tariffs? Many economists argue that tariffs are the real trigger for a potential recession. Trump has imposed an additional 10% duty on China and a 25% tariff on products like steel and aluminum. And while they are currently on hold, he has also put another 25% tariff on trade with Canada and Mexico on the table. But this trade war isn't just limited to these countries. The European Union is fully involved as well. At this point, it seems like no one is safe. If the US imposes a 25% tariff on European steel and aluminum, Europe will retaliate by banning iconic American brands and products even before sanctions start hitting appliances, livestock, food, and other essential goods. These measures are set to roll out in two phases, the first on April 1st and the second in mid-April. And here comes Trump, without hesitation, responding to the European Union's counterattack by saying, whatever they want to charge us, we'll charge them the same. That's why I've been saying the macroeconomic outlook is becoming increasingly complex. Tariffs, the slowdown in business growth, the 0.2% drop in personal spending in January, and the possibility that the Fed might not cut interest rates after all. Of course, this all sounds like a Molotov cocktail. Everyone's an economist now, or better yet, a so-called expert economist. That's just how it is. And honestly, looking at these headlines, you'd have to be blind not to see what's going on. You get what I mean, right? So where does all of this lead? Well, Wall Street investment bank JP Morgan has now raised the risk of a recession this year to 40%. They even warned that this forecast could go higher if the Trump administration sticks to its policies, even in the face of worsening economic data. Let's be clear, this is nothing more than a tug of war between the major powers running this country, and not just this country, but the world. Neither JP Morgan nor Goldman Sachs, who, by the way, also raised their recession probability from 15% to 20% last Friday, are happy about how the traditional market is collapsing. And let's be honest, these institutions have a lot to gain. First and foremost, it's a direct challenge to the US government. They're saying, hey, we're going to keep fueling fear among your people and the global market about a potential recession, which will push up its probability. And that, for the US, is really bad news, because by spreading fear, they can pressure Trump to change his approach, to stop squeezing the economy the way he's been doing with these tariffs. But what else do these investment funds stand to gain? Well, let's say Trump doesn't budge, and we do see this massive, catastrophic recession, though honestly, I don't buy it. What would these funds do then? Simple. They'd keep spreading fear while gradually buying up assets at lower prices. But personally, I don't believe a recession is coming, not with the way the market is behaving right now, along with everything I've just shared with you. To me, this is the perfect Molotov cocktail for institutions to absorb all that retail fear. And we can actually see this absorption happening on the Ethereum blockchain. Right now, there's been a massive Ethereum withdrawal worth $1.8 billion. And that could mean that whales are preparing for a potential price increase. Of course, there are no guarantees. But if you're looking for reasons to be optimistic, these are the kind of metrics you should be paying attention to. And now you're about to hear how Donald Trump has come out to tell us, reassure us even, that the United States will not enter a recession.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
Now, first of all, just because Donald Trump says it doesn't mean we should take it at face value and say, oh, okay, the president said it, so there won't be a recession. That would make no sense. But at the very least, we're not seeing a scenario where a recession is being openly acknowledged as inevitable. And again, it's not about blindly believing him, but at least we're not seeing an extreme stance of doubt and uncertainty. Because if Trump had come out today with a speech similar to the one he gave 3 days ago, it would be crystal clear that they're deliberately steering the nation direction toward a recession to clean up the economy, something that economists have already been speculating about. But now, let's get to the final conclusion of all this, and I'll share it with you in a moment. But first,
welcome to Crypto Insight, your ethical and moral channel for cryptocurrency technical analysis. Here, we really know what we're talking about. We conduct advanced technical analysis that has been developed for over 12 years. We upload videos several times a week. If you're enjoying what you're seeing, let me know and leave a comment with your opinion. Like the video, subscribe to the channel, and click on the bell so you don't miss the next opportunity.
things are looking bad, really bad, both for the US economy and, of course, for the global economy. Even a 5-year-old could see that things aren't going well, right? I mean, come on, when the big players come over, pat us on the back, put an arm around our shoulder and say, listen, I know what's going on, and I'm telling you the chances of a recession are rising. It's hard to ignore. Look, I can only remind you of the VIX and everything it represents. Right now, we're in a moment of extreme fear. Where exactly? Well, if we analyze the structure, and that's something we specialize in on this channel, it's clear that we're sitting in an extreme market zone. But here's something important. We're looking at the daily chart. That's the first thing. For a single candle to evolve, a full day has to pass. This is a slow process. And can we say with absolute certainty that we've hit the market bottom? Of course not. But I'll tell you this, there's a strong case to be made that the traditional market, and soon we'll talk about crypto, could still see a breakdown, a further dip, or some kind of deceleration before eventually continuing on its path. Then again, who knows? Maybe we'll get one of those V-shaped recoveries, just like the ones we've been seeing over the past few years. Let me tell you something. If you turned on the news during that time, all the economists in the world were saying the same thing. Are you not looking at the employment data? Are you not seeing interest rates, inflation? I mean, any economist will tell you what's right there in the numbers for everyone to see. But in the end, if we focus on probability, let me remind you that this was the exact period when the Russia-Ukraine war broke out. And from Crypto Insight, we literally called a bullish market at those points. Imagine all the people back then saying, hey, are you not seeing the war between Russia and Ukraine? Are you not looking at interest rates? Well, look at what happened. You see my point. This is how they play the game with fear. It's their daily bread. Historically, that's how it's always been. And yes, recessions are cyclical. They will always come and go. Nobody is questioning that. But for one to actually happen, certain years have to pass. And if every single year we ask ourselves, is this the year of the recession? Then statistically, it probably won't be. But like I said in another video, statistics exist to be broken. Let's be clear, I don't have a crystal ball. I'm not telling you with certainty that a recession won't happen. I don't know. You don't know. Nobody knows. The only thing I'm here to defend is that you should stay away from any narrative that tells you a recession is guaranteed. Anyone who blindly believes that is missing the bigger picture. I just invite you not to let fear blind you, because it's very easy to get caught up in fear when the market is down, and those are precisely the moments when big institutions step in, absorb liquidity, and move in the opposite direction. And honestly, what I expect from the S&P 500 and the traditional market right now is that we might be in a similar situation to before, where noise keeps building up, where we see a slowdown in the drop before things move forward again. We need to wait for some kind of deceleration before the market finds its direction. Because yes, it makes sense for prices to drop a little more, for more scary headlines to come out, for more fear to be pushed onto the market. But if we're talking about windows of opportunity, and that's really what we focus on at Crypto Insight, then yes, we are in an investment window right now. Of course, this is just my opinion. At the end of the day, everyone is responsible for their own decisions. Do whatever you want, but own it. Like I mentioned before, the crypto market is heavily correlated with the traditional market, and right now I can tell you that Bitcoin is sitting in some very interesting zones. I'll say this, seeing another drop below the recent low would make sense, and it wouldn't be the end of the world. We could also see some slowdowns in price action, and not just in Bitcoin, but also in Ethereum and other crypto assets. Now, I'm about to share an in-depth technical analysis on Bitcoin and other cryptocurrencies. But first, tell me, what do you think? Do you believe a recession in 2025 is inevitable? Or do you think we're actually looking at a window of opportunity without jumping to conclusions? What do you see coming next? Drop your opinion in the comments. Also, don't forget to like the video, subscribe to the channel, and hit the notification bell so YouTube lets you know when we post new content. And now I invite you to check out our latest technical analysis on crypto right here on the screen. Don't hesitate, click on the video now and get a full breakdown of the market. Do it now. Do it fast. See you in the next one.